All right, let's jump right in. There is a brand new IRS rule on the books that honestly could put thousands of dollars back into the pockets of seniors, and it seems like almost nobody is talking about it yet. So, if you're 65 or older, you're going to want to listen very, very closely. What we're about to cover could literally change how you manage your money in retirement for the next 4 years. This is really important stuff. So, let's get to it. So, the big question is there really a new way for seniors to save on their taxes? And the answer, believe it or not, is a big resounding yes. But look, this isn't just some little tweak to the tax code that you might see every year. No, no, we are talking about a major shift, a really fundamental change in how the federal government is going to look at your income. And frankly, if you miss out on this, it could cost you thousands of dollars that should have stayed right there in your wallet. And here it is. This is the number that should really make you sit up and pay attention. $12,000. That's the potential new bonus deduction for a married couple who are both 65 or older and filing their taxes together. Now, if you're a single filer, it's still a whopping $6,000. And I want to be clear, this is not a gimmick. This is real money that can stay in your bank account instead of getting sent off to the government. Okay, so what exactly is this new benefit? Let's break it all down in this first section. We're going to call it a new senior deduction. And we're going to get into precisely what this new rule is, where in the world it came from, and why it's such a potential game changer for so many retirees. The official name for this is the senior bonus deduction. And as you can see right here, it's a temporary additional deduction. It's specifically for taxpayers who are 65 and over. It was part of a much larger package of tax changes, and it was really designed to give some much needed financial relief to older Americans. Now, here's what makes this thing so incredibly powerful. This is the key right here. It stacks. You see, this bonus deduction doesn't replace anything you're already getting. It's added right on top of your regular standard deduction, and it's also added on top of that extra deduction you already get just for being over 65. It's like building blocks. You have your base, you add another, and now you get to put this big new one right on top. And that stacking effect is what makes the total potential deduction so huge. All right, let's move on and see exactly how this works in the real world. In this next section, we're going to calculate your potential benefit. This is where the rubber meets the road. You're about to see the full scope of what's happening and just how much of your retirement income you could potentially shield from federal taxes. And let me tell you, the numbers are pretty staggering. Okay, let's do the math. For a single person who's 65 or older, for the 2025 tax year, the standard deduction is projected to be around $15,750. Now, because you're over 65, you get that existing additional $2,000 deduction. But now you add another $6,000 on top of that from this new senior bonus. So let's add it all up and you get a total deduction of $23,750. Just let that sink in for a minute. That's almost $24,000 of your income that's completely protected from federal tax before you have to pay a single dime. Now hold on, because for married couples where both of you are over 65, the numbers get even more wild. The standard deduction for filing jointly is $29,200. Then since you're both over 65, you each get that extra age-based deduction, which adds up to $3,200. Then you add the $12,000 senior bonus on top of all of that. That's $6,000 for each spouse. All of a sudden, you are looking at protecting over $44,000 of your income from federal taxes. I'm going to say that again, nice and slow, so it really sinks in. $44,400. That's not pocket change. For anyone trying to make their retirement savings last, that is a huge, huge deal. And here's the part that makes this so different from almost anything else out there. This benefit is available whether you itemize your deductions or you just take the standard deduction. This is, well, it's pretty much unprecedented. Usually the tax code forces you to choose a path. You itemize or you take the standard and that's it. But this one, it works no matter which way you go. So if you're someone who likes to keep it simple and just take the standard deduction, great. You get this. And if you're someone who meticulously itemizes every single little expense, you get it too. It's incredibly flexible. Okay, so of course, with any government program, there's always some fine print, right? So let's talk about the limits. We need to cover who qualifies and just as important, for how long. This is where things can get a little complicated, and it's where you really need to pay attention to make sure you can take full advantage of this. This timeline right here might be one of the most important slides in this whole explainer. I need you to understand that this is not a permanent change to the tax code. Let me repeat that because it's absolutely crucial. This deduction is temporary. It is only effective for the tax years 2025, 2026, 2027, and 2028. That's it. You have a 4-year window to benefit from this. So, unless Congress steps in and decides to extend it, this extra deduction just poof. It disappears after you file your 2028 taxes. This means you need to be thinking about this now and making any big financial decisions with this 4-year clock in mind. The other major piece of the fine print is, you guessed it, your income. This benefit was really designed to help low and middle income seniors the most. So, there are income limits that determine if you're eligible for the full amount. This is what's known as a phase out. So, here are the magic numbers you really need to be aware of. If you're a single filer, the deduction starts to get smaller. It phases out once your income hits $75,000, and then it disappears completely once you hit $175,000. For married couples filing jointly, that phase out begins at $150,000 and the deduction is completely gone at $250,000. It is absolutely essential to know where your income falls in relation to these numbers. So, how does that phase out actually work? Well, there's a specific formula. It's pretty straightforward. For every $1,000 you earn above that income threshold we just talked about, your bonus deduction gets reduced by $60. So, what this means is even if you're in that phase out range, it doesn't mean you get nothing. Every dollar of the deduction you can still claim is money back in your pocket. It just means you won't get the full $6,000 or $12,000. Okay, so you know what it is. You know who qualifies. Now, for the most important part, how do you actually claim it? And the good news is the process isn't as complicated as you might think, but you do need to know the right steps to take. A lot of people hear about a new deduction and just assume it's automatic, but it's not. You have to actively claim this benefit. Here it is, a simple 3-step guide. First, when you go to file your 2025 taxes, which remember you'll be doing in early 2026, you'll want to use Form 1040 SR. It's the one specifically designed for seniors, so it has larger print and clearer instructions. It's much easier on the eyes. Second, on that form, you'll see a box that you need to check indicating you're 65 or older. That little check mark is the trigger for everything. And finally, you'll need to complete a brand new form. It's called Schedule 1A, and that is where you will specifically calculate this bonus deduction. Now, let's tackle something that's causing a ton of confusion out there. I'm hearing this rumor going around that this new deduction completely eliminates all taxes on your Social Security benefits. So, is that true? Let's clear the air on this right now because getting this wrong could cause you to make some really big financial mistakes. Let me be absolutely crystal clear. That rumor is false. It is not true. This deduction does not directly get rid of the tax on your Social Security benefits. The rules for how Social Security gets taxed are still the same. So, what does it do? Well, it lowers your overall taxable income. And by lowering your income, it might have an indirect effect. It could reduce how much of your Social Security is subject to tax, but it's not a magic wand that makes it all tax-free. That said, for many, many retirees with more modest incomes, the practical effect of all these deductions combined can be a zero federal tax bill. Okay, let's bring this all home with the final takeaway. We've gone through all the numbers, all the rules, but let's talk about why this really truly matters for your retirement. This isn't just some abstract accounting trick. It's a real policy designed to address the real financial pressures that so many seniors are facing today. So, what does this actually mean in terms of dollars and cents? Well, that $6,000 deduction isn't just a number on a tax form. If you're in, say, the 22% federal tax bracket, that $6,000 deduction saves you about $1,320 in actual taxes, cold hard cash. And that's real money you can use to pay for prescriptions, or to cover your Medicare premiums, or handle that unexpected car repair that always seems to pop up. For anyone living on a fixed income, That's a really meaningful amount of relief. So, if you remember nothing else from this explainer, let it be these key points. First, you have to be 65 or older. Second, it's available even if you're still working part time as long as your income is within the limits. Third, it works whether you itemize or take the standard deduction. Fourth, you have to watch out for those income phase out limits. And finally, and most importantly, remember this is temporary. It's only available from 2025 through 2028. I just want to leave you with this thought. Please do not leave money on the table just because you didn't quite understand how this deduction works or because it seemed too overwhelming to deal with. This is a benefit that was specifically created to help seniors. So, start thinking about it now. Get your documents together and make absolutely sure you are claiming every single dollar that you are entitled to. And one final and really critical warning, please, please be careful out there. I guarantee you there are going to be scams popping up all over the place with people trying to charge you money to help you claim this deduction. You do not need to pay them a cent. All the information and the forms are available for free from the IRS, and any good tax software will handle the calculations for you automatically. So please be smart, be careful, and don't fall for it. And that brings us right to our final question for you to think about. This is a 4-year window of opportunity, a window that, as of right now, is set to slam shut after 2028. It really requires you to think strategically about your retirement income over these next few years. So, knowing that this huge benefit has an expiration date, what's your plan to make the absolute most of it while you can?